The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Our next panel consists of the buy side of our market, because what we wanted was for the people who come to this conference to hear what we're calling is a wish list for the buy side, what the buy side would like from the people at our conference as far as how they trade and what we could do better to help them do their business. If I could introduce to you Steve Sears, the moderator of the panel. Steve is a columnist for Barron's. Come on out. Okay.
Good morning. Thank you very much, Tom. It's a pleasure to be here. I'm with Will Bartlett, Parallax Volatility Advisors, Thomas Coccaro of Bow Street, LLC, Dennis Davitt with Harvest Volatility Advisors, Ken Kwalik, Goldman Sachs Options Advisory Services, and Kyle McClements of BlackRock Advisors. It's with timing being a large part of life, the timing for this panel I think is quite good following Andy Nybo's presentation. What we hope to do is to illuminate some of the issues that he raised. Now, anybody who's attended more than a few of these conferences probably remembers the famous How Do You Grow the Pie panel, which is always a personal favorite of mine. This panel, a wish list from the buy side, is proof that the pie has grown. Consider that in 2000, average daily volume was often about 1 million contracts a day. Now it ranges to about 14 million to 17 million contracts per day, with event-driven spikes regularly pushing volumes up to 20 million. Now, the industry, to viciously torture the metaphor, must figure out how to support a bakery capable of producing these large institutional-sized pies to attract, sustain, and retain some of the world's largest stock investors who have a strong desire to use options to better navigate the stock market and to deal with the difficulties of managing money. But there are certain structural elements, and these elements tend to emerge at key moments in the options market's evolution. And these elements need to be considered, but when properly addressed, they've historically led to enormous growth from the likes of, say, hedge funds and e-brokerage firms, and now they're reasserting themselves around the so-called real money managers. And today these gentlemen will share their views with you on liquidity fees, exchanges, and regulations, and a topic that I think may prove surprising to some, education and language. Now, by way of introduction, I think it might be the most helpful. We'll just go right down the line. If everybody will introduce themselves, talk about how they trade, where they trade, to execute voice or electronic, just to sort of mark everybody in a market.
Great. Thanks, Steve. Will Bartlett, Parallax Volatility Advisors. We manage a relative value hedge fund, relative value volatility hedge fund, and we execute our business exclusively using U.S.-listed options. On any given day, we trade an average of about 300,000 contracts in these markets. Our business is still, surprisingly, largely, a lot of it's still on the voice side. We execute about 40% of our business by contract volume over the phone, and by Vega breakdown, it's still about 60% directly with brokers, and the balance is all electronic.
Ken Kwalik, Goldman Sachs Options Advisory Services. I run a series of strategies for clients of the private bank and the investment management division as a whole, specifically within the recent regime, the recent years, yield enhancement strategies and the like. As such, it's a global team. We trade across both Asia, Europe, as well as the United States. And I would say in terms of trading, we typically live within the first 4 months or so of, like many here do. We also trade a decent amount of slightly longer dated, so 9 months to a year out, in the equity and index flex markets with a few structured notes.
I'm Kyle McClements at BlackRock. I represent the Fundamental Active Equity Group. Our business in derivatives is a global business. Probably 2/3 of it's in the U.S. The rest is throughout Europe and in Asia. In terms of options, we do also stay on the front end of the curve, usually typically the first month to 3 months. However, we do move out as needed. In terms of the business lines, we have a number of covered call strategies, but it's not just that. We also use options for any of the BlackRock mutual funds and the like. So we try to serve, our derivatives group serves BlackRock fundamental equity overall.
T.R. Coccaro, Bow Street. And we're a long-short, catalyst-driven fundamental fund. And I'd say we use them primarily for hedging, which would go out 2 to 3 months, and then the other 50% would be for expressing our views, mostly catalyst-driven, and those tend to be 9 months to a year out. And I'd say we're 50-50 in terms of the usage. Electronic, primarily for the hedging, it's just ease of use, and tend to go to the brokers for some of the more illiquid names.
My name's Dennis Davitt. I work at Harvest Volatility Advisors, which is a wholly owned subsidiary of Harvest Volatility Management. We trade across the curve wherever the customer needs. We come up with more bespoke solutions for institutional clients, more in the pension fund, endowment fund space. So we actually lean more towards longer dated options, but not out to the 5 or 10-year OTC space.
Thank you. So, gentlemen, the industry is increasingly listed short-dated options. Would you benefit from different expirations or contract specifications? For example, a jumbo call or put that is the equivalent to 10,000 or 20,000 shares and that expires the day ISM is released or a day after earnings. Double D?
The shorter-dated options don't really, in our line of business, I mean, they've been incredibly successful, but for what we're developing and what we're looking at, there's less of an appetite. We look for people with portfolios that are on the order of billions. So for them to be moving in and out of shorter-dated options doesn't really fit our model right now. We're looking, like I said, more towards, these are people with super tanker type positions that they're looking to either create yield with or put some sort of tail risk hedge in place. So to be, they're low touch but high demand clients. So a lot of hand holding going into the trades. So high transactional things, which would be on the shorter end of the curve, we don't use a whole lot of.
I'd say about 5 to 10% of our business tends to sometimes get into these weeklies, and they're like lotto tickets, and it's kind of like gambling. 10% of the time they hit and you're excited, but the other 90% it's just almost like wasted money. But occasionally, especially in earnings season, if we have a view and we want to express it without putting too much capital up, we'll tend to go into those.
Since our business is very focused on the front end, having more options outstanding on the first couple of months has been tremendous value to us. Recently, there's been the move to have at least the first 3 months of options listed at all times. That's been a huge benefit from previously just maybe the first 2 months and then the normal cycle. So that's been a great development for us. A lot of our business, actually about 55% of our business is over the counter. And the reason for that is really 2 primary reasons: is the customization, having the strike, the date that you want, and the anonymity of it. But listing more options on the front end where we generally play, that clearly attacks the one aspect, the customization. So there's more that's in the front end is tremendous help for us.
I think the more of the surface that you can trade and that's available to, if anything, get information from, the better. When you get inside of sort of the 15 trading day window, that's not an area at this moment that we're extremely active in. We're more interested in some of the weeklies that expand, in those buckets between the first and second months where you overlap the 30-day sort of window of theta decay and various dates, single stock events and macro events. So we're starting to use them more. I think they're a positive in general.
I think they're definitely positive. I don't think we need any more. We got 50-cent strikes and options expiring every week and every quarter, and it generates a lot of data and produces some really pretty-looking volatility surfaces. That's useful. I think the liquidity is less per strike as a result of it, and it creates a lot more data management, a lot more data that you have to store and analyze.
When you gentlemen are trading, what's an average size order? Is it 20,000 contracts that you scale into it, or is it just something different? Dennis?
Oh. So the average size of the orders that get done? Once again, it varies. I'd say currently right now on the management side, though, it trades in blocks of $2 billion. So, that's in SPX. It's a pretty big order. It's not a high-frequency order, but it's rehedging a yield instrument across numerous RIAs. So liquidity is really important in that. Fortunately, it lives in that big product. SPX is probably one of the more liquid, probably the most liquid product out there. So we're fortunate in that regard. The strategy could be rolled out into other assets, but we kind of bump up against liquidity problems.
In terms of listed contract size, our average is about 1,500 each position, I'd say on average, and we tend to like to get some on, and then we tend to work it. Whereas when you do deal with the dealers, they like to get it on, and then they can hedge themselves out, and that's why the electronic's been advantageous to kind of work smaller lots.
For us, the size runs the full gamut, from small positions to the largest contract limit kind of thing. It's all dependent on the fund itself. Rarely do we go across the board for a number of different funds. So it depends specifically for the fund and obviously the assets that they manage. So we really run. It's hard to say the average, but we've got pretty much a little bit of everything.
I would agree with Kyle. Our size ranges the full gamut. I think one of the big benefits to the commoditization, if you will, of especially some of the index products in the shorter dated space is that you can get some real scale to that business and wind up trading for many smaller clients because of the ease of electronic access and so forth. I'd say, though, for our biggest clients, especially in the high net worth channel, the high touch sort of, especially the flex market, and when you get into single stocks, even some of the bigger names, our key relationships are still as important as ever. Sourcing liquidity, and whether it be on our own or using flex auctions or whatnot, is still as important as ever.
And for us, there's no average size, but the size is often a direct function of liquidity in the marketplace. So oftentimes we want to do something much bigger than there is liquidity in the market, particularly in the single stocks.
How often do you bring the order to market, you're not able to get enough liquidity, and then you're forced to go OTC?
Our business is all listed, so we don't go OTC, but we certainly spend a lot of time shopping and calling different dealers and trying to find the other side of trades.
All right. We do a significant amount of that. When we actually started this business, we were almost exclusively OTC for our single stock positions. As we found, especially through 08 and 09, when there were a lot of players exiting the space and then new players coming about in the years after, we found the use of the flex market in particular to be very useful. Again, conducting our own auctions with our liquidity providers that we have relationships with. I think really anything above like a 2,000 or 3,000 lot on a standard price nominal name, we've found that liquidity first before necessarily going all electronic.
Yeah, as I mentioned, more than half our business is OTC, and a lot of that is, when I mentioned anonymity before, that could be a term for liquidity as well, because inevitably we have a lot of dealers come back to us and ask us if we present them with a listed trade. They ask us, can we do this OTC? There's times we can, there's times we can't. There's certainly times that we do or don't want to do that, but that can be a large factor in driving something to the OTC market, is their ability to get their hedge and price the entire piece appropriately.
25-30% of our business is over the counter. It primarily tends to be the more macro-oriented trades that we like to customize and kind of push out on a 6-month to 9-month horizon.
Everything we do is listed due to the clarity of the market. I mean, the yield characteristics of what we do, unfortunately, looks a little bit like what Madoff was claiming to do. So the fact that it prints on exchanges and the clarity that comes through with that has been really beneficial to the growth on the management side. And on the advising side, there's definitely an appetite out there for simpler structures that are in the listed market. That's what we're coming up against. A lot of people, especially on the institutional endowment side, get pushed by the investment bank community towards OTC transactions, and there's kind of a pullback from that. That's the opportunity that we see in starting a new business.
What do you gentlemen need the exchanges to do to attract more of your business? Do you need a special order designation like I, or a strategy designation like fundamental buy right to help reduce order friction? Will, if you take that one for us.
I mean, for us, the order types are fine. It's more a question of fees. The exchange business seems to be the only business that I've seen where you get more competition and higher fees at the same time. So, we're trying to find ways to trade less and get more exposure. using higher priced options or avoiding low dollar stocks because the per contract fees that we're paying are continuing to rise, and it's a significant impact on our business.
Yeah, I think in general we favor an approach that's more simplistic than anything else. I mean, those costs of maintaining those orders and whatnot, and everybody along the chain fully understanding them, are going to be passed on eventually to the customer, either explicitly or implicitly, one way or the other. And our general feeling, I think, while there's been some good developments, I think the simpler the better, and focus more on educating the clients on the basics of the strategy and focusing on trading signals and what volatility can do for someone's portfolio, as opposed to getting into the weeds too much and having to constantly explain that further.
I think there's a number of things. I mean, the first we already spoke about is, for us, listing more of the front month options, more single stock or single strike price increments, more on the front end, but also taking maybe a cue from other exchanges, like, for instance, in Canada, if there's a listed option that will be listed eventually, if you're following the same protocols, the same series, they can automatically list it within 15 or 20 minutes, knowing that full well it'll ultimately be part of the regular series. So they'll basically roll that series up, and you can then trade it listed, the same day, which I think is very helpful. Then the last thing I would say is understanding between their dealers that we deal with the protocols on how to manage certain trades, pre-hedge exemptions, and things like that. It seems like all the different dealers have different interpretations of the rules and how they might be applied to handling some of the larger trades or more difficult trades, and so get more clarity with some of that in the protocols.
I'm not sure this is more for the market makers than it is the exchanges, but for us, the tab group presentation, 72% of all the volume is in top 100 names, and we're a small mid-cap based fund, so our names tend to be more illiquid, and we would use more listed options if those mid and small caps that don't have as much volume had tighter spreads and there was more liquidity there. We often will look at them, we'll be like, have to go to the broker, maybe do a flex, but even then, it's like I'd say 80% of the time when we want to express a view on a small to mid cap that's not in that top 100 in terms of volume, we'll end up not doing it, whereas we would express our view through options if the liquidity was there.
Yeah, I would agree with what Kyle said about the pre-hedge exemption and the interpretation. It has less impact on our business, but it would provide more avenues for us to do trades if there was a better understanding on the investment bank or broker-dealer or liquidity provider side going into trades. I mean, I used to wear that hat, and I know it was very difficult. That's why we trade everything OTC. So, they could affect a hedge, and you trade everything in percent of price. And then you can bring it to the floor and present it tied up with its delta neutrality. We've had this conversation before, and the exchange is moving towards that. I know it's not an exchange thing, it's more of a regulatory thing, so I commend them for that. And the other thing I would say is continuing what they're doing, reaching out to Andy's slides from before, like the percentage of the equity investing market that really aren't using options.
Let's talk a little bit about educational language. We started talking this before we came on stage, talking about the complexity of the iPhone, but yet its simplicity versus using Windows. I think, Dennis, you said that simplicity is the ultimate sophistication, and yet this business of puts and calls is so complicated that it often defies simple talk. What do you gentlemen need from the options industry to help you more effectively deal with the portfolio managers who are very sophisticated stock pickers, but they may not think of the market in terms of volatility and gammas and deltas? If you just start with this.
Well, for us, it's all we've ever done, so options has always been our business, so we don't.
Well, that actually kind of tailors right into my. I have, like I said, we're a long-short equity fund. I've worked for multiple PMs over the years, and the two guys I'm with now definitely understand, volatility and options. But, when they get a pitch from a sell-side shop that discusses an iron condor, they just look right beyond it. So I mean, it definitely from the sell side to the buy side in terms of the derivative desk, the simplicity of explaining, you get taken out at this price, and we all might in this industry understand that, the Vegas and Thetas and all that, but for the most part, some of these guys, your portfolio managers could be pretty smart guys, but they only have so much capacity to work and understand on things. This is only, like I said, this is from the long short portfolio manager side. I'm sure there's some PMs out there that are vol guys and understand all that, but simplicity from the sell side derivative desks, explaining more. I've worked with one broker in particular. I've explained to him over the years. I'll be like, look, this, I'm not going to be able to pitch this to my guys. If you want to, if you're sending this out to other long short guys, I would do it like this. And we've kind of come to an understanding, and it's kind of funny. Like I think he's kind of built his business with some of the consumer PMs who have come to him because he's dummied it down for them.
Yeah, on the back of what Steve said before, I always steal the quote from Steve Jobs where he said, when he was making fun of Microsoft, he said they have take a very simple question and come up with a very complex answer. And that kind of goes into the same sort of thing. If we can keep it really simple, that's why we live a lot in the listed space. An example I use is when you talk to a portfolio manager about hedging risk, you can go back to like life insurance or homeowners insurance, which is an incredibly complex business, actuarials. But they ask you 3 questions: how much coverage you want, what's your deductible, and that yields a premium number, and then you start from there. And they're like, I don't want to pay that much. Well, you lower your coverage, your contract, or you move your strikes around. And that sort of answer, simple question, simple answer, gets traction in the business outside of this small piece of the pie that we're all fighting over. There's 80% of the people who don't use options, but I think if you put it in a simple form, like an insurance policy, we'll get more traction for the business in general.
I would add on the fund management side, it's one of the keys is moving beyond the traditional benchmarks. Obviously S&P 500, Russell 1000, et cetera, those don't have options in the benchmarks. So you have a lot of managers that have those benchmarks. They're reticent to put options into the portfolio in fear of the tracking error associated with it. So one of the keys is to move beyond those traditional benchmarks to investors and take a more outcome-based approach to investing, more risk-adjusted returns to investing. So try to sell products that are less focused on the traditional benchmarks that ultimately get rated by a number of the, Morningstar, et cetera, that will give you reviews based on those benchmarks. So if you can set up a series of, or promote to investors a series of funds that are more outcome-oriented, risk-adjusted returns, fund managers will be more apt to put those into the portfolio and use them as a dedicated part of their strategies.
Yeah, that's a huge point. I think the risk-adjusted return sometimes, is especially for short volatility strategies, is a point that sometimes gets lost with, with how to think about it. How to think about benchmarks, for example. It's a great point. I think just continued education. I think some of these forums really help. The attendance at some of these things the past few years, especially as you look at the VIX and the growth of that product, especially. I think I saw a stat that there's more Vega in that product now than the SPX, and I think that's important to get people's arms around what that means, how a mean reverting asset class trades, and really just continue that education. I think a lot of people, the question we get all the time is, why would you sell vol with VIX so low? Well, it's you can be the smart person that sells it on the first uptick, but you sell VIX at 16 and it realizes 20, that's a loss. You'd rather sell it at 12 and have it realized 7 or something. So it's getting people to think about it in the right way, and of course how the VIX settles and all the mechanics of it on top of that. But I just think further education is the key here.
I think that's a great point to open it up to questions. I know that we have microphones scattered about, so if you'll wait for them to come and just fire away.
Hi, good morning. Terrific moderating, by the way. I had a quick question on what you make of the exchange structure in the options industry. As we've heard today, and as we all know, we've seen a number of growth in the number of exchanges, and these exchanges are trying to differentiate themselves in some way in the offerings that they place to the market. How do you see that structure kind of evolving? I mean, are we going to see a paring down of the number of exchanges over time, or how do you see the exchanges kind of differentiating among themselves?
That's a great question. When I was looking at Andy's thing before, and I remember saw the timeline and saw the box coming out, and I was thinking, God, these guys are really late to a party. And now we have twice as many exchanges. It feels to me, from my experience, there's too many. It adds a lot more complexity. I'm a free market guy, so you should have free competition. But I think some consolidation would be in order and would save us all some money. We're paying regulatory fees to each new exchange that comes out. So the MIAX now, everyone in this room is paying, a fraction of every option trade they trade on the CBOE gets charged a regulatory fee on the MIAX. So every other exchange that comes on, I'm assuming, is going to do that and further raise our costs and further raise the infrastructure costs, of the industry as a whole. You got to route to these exchanges. Market makers got a right to it. I think in the end, it's detrimental to liquidity. So, ideally, you'd have fewer venues, but you need to have multiple venues. And a lower cost structure, which hopefully should increase volume and liquidity.
Absolutely. I mean, when I think more complication, I think just more cost, again, implicitly or explicitly. It's going to find its way through. And I think in terms of growth opportunities, I think there's a lot of the U.S. model can work well with some of the foreign indices, namely some of the MSCI indices and so forth. I think index products are a great way to encourage growth in those regions, and I think there's just so much more wood to chop there. I'd like to see further development along those lines as opposed to, a slightly different maker-taker model or something like that.
I think one of the benefits is you see the development of different order types, given the different market structures and pricing models, a lot like you have on the equity side, which can really potentially enhance direct access and going straight to the market for people like ourselves. That's one of the benefits, but you got to obviously versus the cost. Is that going to drain liquidity, fragment the market too much? You see that the conversation almost going back to that on the equity side. That are the spreads too tight? Sacrificing overall liquidity, and so that's the key balance you have to strike. But I think clearly the benefit is bringing more technology to it, more competition that's enabling more order types and handling like you have in the equity market.
Actually, when it comes to exchanges, some of the institutional guys, traders that I do talk to, they have an equity montage and an option montage, and to them, they don't see the difference. They just see bid ask and bid ask because they have a composite button and all their exchanges are put together. And I know 3 or 4 guys. If I asked them, I said, how many option exchanges are there? They'd be like, I don't know, it's electronic. And that's just an education. From an education standpoint, there aren't many buy-side traders here. It is more the market makers and stuff like that. I hear a lot of the guys do go to the CBOE risk conference, but and that said too, another thing about electronic and what you were saying, touching on the equity exchanges, I wonder what's going to happen with commissions. Everyone keeps seeing equity commissions going like this, and a smaller shop like myself, we've run into the issue that we're not paying the street enough because we're a fundamental shop. We need to talk to the street. Our analysts are constantly talking to other analysts, and we've actually discussed and changed. And JP knows this. I called him recently and said, what would you think if we raised our commission? And I wonder. You can only bring them down so far. I don't think that's happened with the options world as much because the margins there seem to be a little bit bigger.
Yeah, I mean, as far as I echo a lot of what you said, as far as the exchanges and there being a bid-ask and it just being a fungible product regardless of where it trades. The question was, what can the new exchange do to differentiate itself from the current group of a dozen plus? And I think it had to take a different tact. I mean, there are so many exchanges probably because running an exchange is a profitable business, I would imagine. That's why there are a lot of them. And if it's not, then a lot of them eventually will go out of business, which is a whole new dynamic than we had 10 years ago. I do think, though, that if an exchange could come out and do something to differentiate itself outside of a different payment for order plan and really open up a whole new line of business. Like, no one's going to sprinkle pixie dust and make liquidity. But if an exchange comes out with an effort that reaches into a new part of the market that could supply volatility into the market, a yield product or a tail risk product, and almost be strategy-specific exchange. I know it's completely different, but I trade my tail risk on the, the Joe exchange, whatever names are left. We're running out of names faster than the exchanges. But I mean, to me, that's like something different. Like, you want to be a different sort of exchange. We really cater to this sort of client. It would be, I don't know if it'll work.
Well, you can make the argument that's where the OTC market comes in. But like you said, you guys stay listed. But,
or replace. Be a flex-only exchange, right? All we do is flexes.
I think there's also some real opportunity in the longer dated markets, and we have a permanently upward sloping index vol curve that I think, a natural demand supply and balance there that I think there's something that can be done there. I'm not sure what it is, but there's a lot less capital being committed to the people that want to buy that protection, and I think there could be something down the road there as more things get securitized and so forth.
Do we have another question from the audience? The question was, the size of the lit market matter, or is it algorithmic?
Yeah, so, equities execution is all algorithmic. All the size on the screen is small. Options is clearly migrated in that direction. Should we be at all concerned with the size of the lit market pushing you guys towards OTC? Or does that not matter because there's execution services that can just, algorithmically trade you into whatever size you want?
I mean, a lot of the mid and lower tier stocks, the lit market's really just an indication of where things are. You want to buy 1,000 options, there's 10 offered. The offer price isn't what you're going to get, and you're going to spend a lot of time trying to find counterpart to that order, and there's nothing you're going to be able to do electronically to get that order done. I think that if you're trading SPY, the lit market's great. You can buy and sell as much as you want. But when you get to the lower tier names, it's really just an indication.
Yeah, I don't know that it's a good one-size-fits-all answer for this. I think for the smaller orders, it's fine as is. I think for bigger orders, it's still going to be a service business. And I think, in some ways, maybe a super tight market can hurt you in the way that some people maybe think that does in the cash market with predatory algos and so forth, and it becoming an algo arms race. I don't think that's where anybody wants to go. So I think it's kind of to be determined.
Yeah, I would agree that it's, having a tighter market with a smaller size can sometimes be a detriment to the overall liquidity. And, a dealer is pricing that up a larger piece. They'll see that, and it'll make it more of a indication that perhaps they'll not be able to get their hedge off, or, people will jump in front of that. So that's what, often they'll ask, can we go to, OTC of that. So certainly the bigger size is better. I would prefer, bigger size and a wider spread, but that's characteristic of our flow that's, generally bigger. And it's the age-old question versus institutional of retail.
I'd like bigger size, tighter spreads. Algos, it seems to me it's always like the option world's five years behind the equity world in that regard, and you can see it going in that direction. They're more and more sophisticated, and you can see amongst the brokers that I have on my front end, it's you can see, whereas they're almost all the same equity-wise, I'd definitely say you see the difference with each broker when it comes to the algos and options, and I'm sure 5 years from now they'll all be the same, but right now there's definitely differences, and I think it's because there's the different exchanges also.
By the time you get to me, all the good answers are taken. I think that one thing, having been doing this for 20-plus years, I do see the options market being the round peg being jammed into the square hole of the equity market. If you look at the compression of commission rates and so on and so forth, and the tightening of bid-ask spread, I don't think, if I put on my hat from my old shop where we ran a institutional trading desk, the demand from the buy side of saying, I see this market, that's what I want, you're going to put me up on that size. And, it seems like lately, maybe it's a countrywide thing, that profitability is a 4-letter word. Like, market maker's job is to make money, period, end. And it's a noble profession. But when you remove that ability to make money, like Andy said earlier, a lot of the market makers are no longer in the business, and that's taking liquidity out of the business. The banks stepped in for a long time, provided a lot of liquidity. That's not a very profitable business, providing liquidity in single stocks outside of those top 10 names, so they're moving away from that. So, as far as the lit market, is that really helping our market grow, or is it hurting it? I think it helps in one regard. I think on the institutional level, it hurts.
Hi there. So there's been a lot of discussion on the liquidity of the U.S. option markets, specifically listed versus OTC. But many of you have talked about managing, let's say, global derivative businesses. So how would you compare the liquidity in the U.S. option markets versus the liquidity in non-U.S. listed markets?
It's nothing really to compare. I mean, there's no liquidity. I mean, from what I've noticed in Europe, and everything we do pretty much overseas is OTC.
Having worked at international banks, I can tell you that whenever a big chunk was done in Europe or in Asia, the loose hedge was always put on in the U.S. market and then tried to work back out of it. So as far as getting stuff done, it's always interesting to watch a European trader come over to the U.S. market and start trading an index book or something like that, and they're like, sold, and like, what do you mean you're still there? It's like, oh, no, it's bid on. Actually, it's bid better now than where you just sold it. So this guy, as an American, I enjoyed that, but very proud. Get the military here, so I'm going to get that in.
Yeah, I mean, I think as our business is very much global in nature, and there's a stark contrast between the two. We're trying aggressively to grow, especially in Europe, to regrow, whatever you want to call it, the listed screens. I think there's a lot of work to be done there. Exchange proliferation, confusion between fees, stamp taxes, I mean, you name it. It's just, and that's why so much trades OTC. I also don't think there's a healthy market-making community necessarily, and I don't know how you put that genie back in the bottle, so to speak. I think one thing, this is a point I was trying to make earlier, I think one direction you can go in is some of the index products. I think you can grow those, you can market those, and get people to put a foot in the water, both on the on the buy side, as well as bring that market-making community back. Dual listings in the U.S., some of the ETFs that, for example, track some of these indices, we've had options listed on them. FEZ, the Fez, is one example where it's actually grown a decent amount because people want to play those themes, and people, more institutional as well as some retail investors, are thinking globally and are benchmarked globally, and that is a big story. And I don't know, there's a lot of work to be done there.
Yeah.
There's been a little bit, at least a few of you, talking about OTC and Flex. From where I see it, I don't see a lot trading on Flex. I'm just curious if I have a misconception, or if you're looking to trade more on Flex versus OTC, what could be done to help that?
Whoever wants to take it.
We trade a fair amount of Flex options. The way it usually works for us, as a practical matter, is we'll talk to one dealer, and they'll come back and price it usually in a couple of minutes, and then they'll just, I don't know exactly the mechanisms for it, but they'll print it on the tape. We've never found that it actually creates a sort of bidding competition or gets other people involved. It's been the one person we call directly to, whatever dealer it is. They'll price it. We'll either trade it with them or not. I think the 3 instances where someone else stepped in with a better price, the trade was canceled an hour later, so someone mispriced it, and it was taken off the tape. So it's really just a mechanism, sometimes from our perspective, to take the place of an OTC in a faster framework. People tend to price the flexes faster, 2-3 minutes. Sometimes on dealers' desks, they can get queued up with a lot of OTC, and the pricing is not coming back fast enough. So it's usually a quicker mechanism to that.
Yeah, I think the fungibility and the central clearing aspect of Flexes is something that we find, especially, again, with multiple players rotating in and out of the space in 08 and 09, was a big positive. I think it's an education thing in part. I think the prints are there. They're just sometimes they're a little too big for the smaller market-making community to want to kind of step in there, and other times they're too small for really anyone to care. With us, we put mostly our biggest trades up there. We typically do, similar to what Kyle said, we typically do an auction on our own. We've worked with some of the exchanges. I think SIBO's done a great job in trying to further the education of Flex. We've actually tried to do this in Europe using BClear a decent amount recently. But it's just still a work in progress, and I'm just not sure everybody's fully educated on who the players are. Maybe some people view the flow as toxic.
I think it's a tough thing to, just real quickly, it's a tough thing to market, right? Because the dealers are really not going to embrace flex options, right? They're going to embrace the OTC options. That's really what it comes down to. If you can figure out a way to incentivize, and it may happen with Basel III where they won't have to hold it on their books. It might actually be more financially beneficial for them, coming back to that evil profit motive. It may be more beneficial for them to trade more stuff flex because it may get them around capital requirements that they currently have to face for stuff they hold OTC.
That's a great point. Then they hold the unwind and so forth.
Yeah, like you want to trade OTC when you're at a big bank. You want to trade OTC, you don't want anyone to see it, you want it in your backyard. You don't want to have to put it out there for everyone to see. Now there's this lumpy distribution, which could be in a somewhat illiquid stock. And, so that you can sell the privacy of it, but when profitability outstrips privacy, then you'll probably see an acceleration in the flex trading.
I think that's a great point in which to end. Thank you, gentlemen, for sharing your insights, and thank you for your questions and your attention.
Thank you, guys.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.